real quick. Hi, guys. Welcome back. Welcome back to the longest stream of your lifetime. Welcome back to Morant's Rants. Plenty of good information, a little bit of motivation, a whole lot of truth, no financial advice. We are going over the AMC earnings report. It is myself, and we have Running from Bears. I'll let him introduce himself to a point, but I'll give him this introduction. He is a well-known contributor to Reddit. He's been with us in our Discord for about a month and a half, but he's working it out with us. He's a CPA, and so that means he's a certified, and he knows how to do some math and he knows how to read some charts, and he's with me. We break this stuff down the best we can. I'll ask all the right questions. Obviously, I do balance sheets in a different way, but we've come to an agreement with the little things. I'm more along the controllables. He can really explain the liabilities that are non-controllable and what we look at, and we'll go from there, line by line, which is great. I know that you had some charts you're looking at, but this is Running from Bears, guys. I always call him Running with Bears because I always try to give him that athletic ability, but he's running from Bears, which is already something amazing to do. How you doing today, brother?
Doing pretty good. How you been doing, man? It's good to finally talk to you.
It's been good. I know you've been hanging out with my lawyer friend. It's been going good, but I'm happy you're part of the channel, part of the chat, and then contributing the best way you can. I met you on PPC.
You got a great team here.
Thank you. Hey, can you tell PPC, Zach? Can you tell him my team is thick and deep over the shit? I mean, this guy, man. He came in yesterday.
I'm not touching yet.
No, he came in yesterday to the chat, and he just hung out all day. And I shit all over him. I love the kid, though. He needs help. It's all right. Just, he's ugly. What can I do? No, I'm joking. Hey, guys, let's be focused. Let's be real, okay? And a lot of you guys are here for the real numbers, the real information. Some of you guys are invested in AMC. Some of you guys are invested in Bed Bath & Beyond. Some of you guys are invested in Kohl's, GameStop, Target, all the companies that I go over retail-wise. We're going to look at this chart really quick. Just from your first perspective, actually looking and hearing, what'd you come up with right there from Adam Aaron?
I mean, it's just, I just felt like he was holding the shareholders hostage, right? Like, how long did we harp on dilution and almost no time on any kind of turnaround, right? Like, just, liquidity's fine. And then, oh, by the way, if you don't give it to us, we're under, right? So I kind of struggle with that aspect of it. Because it's $1 billion loss, right?
Yeah, I said that the minute I read. I said, how is this even bullish? And people are okay with it. The company lost $1 billion this year. I'm reading that right.
If you do, yeah, no, it's right. Like, they had less than $4 billion in revenue and about $970 million net loss. So just doing redneck math, you'd have to be closer to $5 billion to break even, right? And then, so I went back and looked at balance sheets. And really, the writing was on the wall back in 2017. Like, it goes back that far. And I think 2019, when they loaded up on the operating leases and assets, that to me kind of sealed it, because the debt load it's unmanageable, right? It'd be fine if you're actually turning an operating income, right? But you're not, because even by conservative metrics, if you're losing money, you can't even pay your interest expense, right? So it's not even there,
right?
But out of the gate, less than $1 billion hurts, right? They held up, gross margin held up, and they did take an impairment loss, and I thought that was a little cheeky when they were trying to not fully own that.
Yeah,
and it's more than it was last year, but given the market and how their business is doing, there's going to be more impairments, right? This is a thing, right? When your business starts heading south, you're not generating the cash flow, the fair value's gone down, so you have to take these impairments, and they're one timers, but the CPA in me gets bothered by that, because it's symptomatic of something else, right? And it's the problem. The business is struggling, so stuff's not worth what you thought it was worth, right?
Well, just the market itself, right? So I'll give you the example. Right. And just so everyone's clear, I'm going to try to clear this up for you guys. The best way I can do it is they grabbed a large amount of goodwill impairment, when they bought Odin movie theaters and Carmike movie theaters, because they bought them for $2 billion. So they had this value towards the balance sheet because that's what they paid for them. But from what I'm knowing now is, over the time frame, that value has decreased because they're not worth anything. Is that correct?
Yeah, that's right. And then if you even look on the balance sheet side, one of the things interesting, if you go to the balance sheet section, these earnings reports, right, they're highly curated, right? So it's interesting to me what they give you and what they don't give you,
right?
So if you go they give you a little bit of balance sheet data. Like if you scroll to that real quick.
Which one is it? The top one right here?
What are we? Page 8. It just says consolidated balance sheet at period and
not key factors. Okay, no, I got you. I'll keep going. There we go. Consolidated statement of operations.
Let's go. No, it's gonna be. Go down one more page.
Okay. Oh, there we go. Consolidated balance sheet. Got it.
Yeah. So what's interesting to me is like they give us all this gap data, but they don't really give us the balance sheet, right? And that's kind of what I want. And they kept talking about how strong the balance sheet is, but when you have a shareholder's deficit and it's negative, right? That means you've got accumulated losses over time, right? So like to put in a house example, like you bought a house for 500 and you have a mortgage on it for 750, right? So it's going to take cash to get out from under it because like you're upside down in it, which is same from a business perspective, right?
Right.
But when you look at, so they kept harping on the liabilities got better, but it's all smoke and mirrors. Like, because if you take assets equals liabilities plus owner's equity, right? So if I take the 9135 and I add the shareholders deficit of the 2624, I get 11.7 billion. And at the end of Q3, they had 11.78 of liabilities. It's like overall liabilities hasn't gone down, and then meanwhile assets has actually decreased by 70 million, right? So
yeah, so it would have been 20. It would have been what would have been 12.5 the year before.
So I was looking at end of Q3 for this year, right? So if you go to the Q3, I had the Q3 balance sheet pulled up, right? And they had total liabilities of 11.78 billion, right?
Hold on,
and
I can get there. I can get there.
Oh yeah,
Q3.
Yeah, sorry, my video's on a bit of a delay, so I can only hear you.
All my stuff's all over the place. I have to like highlight you, do all this stuff. So the consolidated balance sheet for them here is going to be, is it this one with total assets on there? Because you're on that one, right?
Yeah.
Okay.
Yeah.
So I'm there, but is it you going to the bottom?
Yeah, go to the.
Yeah, I see it.
Let's go to the. Yeah.
All right, so right there, it'll tell you. Of course, my mouse goes crazy. So it was at 10.3 before versus a 10.8 on Q3.
It was at total liabilities was at 11 point. That's Q1, right? I mean, it has gone down from Q1, but we kind of flattened out 11.7.
Yeah, I see what you're saying. But
so it's just, that's kind of my thing about these management presentations is they just give you enough, right? And if you start backing into stuff, when he talked about the cash flow and how strong the liquidity was, I kind of took issue with that because it's, so end of Q3, right? Like I thought we had just shy 900 million of liquidity, right? You had call it 700 million of cash plus about 200 million of unused borrowing. Well, they're down to 840 million now, which is better than I thought. But that's not strong by any means, because like when you look at, if you're doing the math on what's truly a strong liquid position, you compare the basic cash plus cash equivalents against the current liabilities, right? They've been upside down for some time now. And when you take that coupled with sustained operating losses, that just means that you just keep digging the hole deeper, right? Because like you're not making the money up to plow back into liabilities, right? You just keep having to borrow more to offset these losses, right?
So these guys want to read the 10K really quick. Let me see if I have the right one up. I believe I have. This is last year's. Okay, hold on. So you guys want the latest one. That's the latest one right there. It's a 10Q because it's a quarter report. It's not a 10K.
Right. So it'd be the 10Q for November. Yeah, you're right.
So here we go. We're looking at this right here. September 30th when it ended versus this one. So these are the numbers that we were going over before. This is from last quarter. So if you looked at the cash on hand for him, as I go down, I have to go all the way down. Cash and cash equivalents were at 684 in September.
Yep.
What did he report right now?
He reported 631.
Yeah,
right?
But remember that he sold off $300 million worth of equity. So, am I correct?
Right. So when you break up, that's a valid point. So when you look at the cash flow, it's all coming out of dilution, right? And then even when you crack open the financing section, you can see that they're having to keep roll this debt out, right? So in 2019, they had notes due in 2022 and 2023, and then you fast forward to this Q3 and the cash flow statement, and you can see where they took that debt and rolled it out to 2029, right? So they keep having to kick it 2-3 years out. Well, I mean, businesses do that, but it's fine. But it's not fine when you're burning mountains of cash, right?
Well, they only have enough for 2 more quarters if they're going to go this route. But even then, they would have
That's kind of what I thought.
They're going to dip into like, so I'll just do it to you like this for all the guys out there that are paying attention. This whole chart here is telling you that they need to vote yes, or they have to, like you said, it's going to swing fast. They're definitely going to have to file for bankruptcy if they don't get a yes vote. And it would take, like, I would tell you, it'd take you like about 6 months. 6 months just by what I see.
Yeah.
Because it would take the cash off the table from the FPA, from the forward purchasing agreement that they have right now, the future purchase agreement with Entera. And then that would in turn drop their price. I mean, the stock price would tank so bad. I don't know what they think they could sell the remaining apes for that they have, because if they don't commit to those 250 million ape, whatever the hell it is that they're trying to sell off. I mean, it's just a weak balance sheet. I don't know why you keep saying they have a strong one and then asking for favors to get a better one. It doesn't really make sense to me. But I listened to
There's nothing strong about it.
I was falling asleep the whole time. You know, I got my guys in here. All these guys are having fun in the chat. I got that. But the not fun part is, okay, I'm a CEO, right? If I'm a CEO and I'm sitting there on an earnings call, why the hell would I be bringing up my competition's numbers at all? Like, it does not matter to evaluate from one to the next. I should be evaluating myself. Like, if I'm going to tell you know, this is what I did 5 years ago versus what we're doing today. That's what we should be talking about, not the fact that a failed movie theater company, a different one, or whomever, is not performing up to your standard, because your standard is still below what it takes to be profitable. So it wouldn't matter just because they're not profitable and so are you. We're still, it's status quo. You're still in the same spot. So I thought it was very unprofessional for him to do that. More so, you're doing the vote. I don't need to know your personal reasons why you need to vote. You know, this whole, I have 8 million shares because I have 4 million of this and 4 million of that. That doesn't make any sense to me either. I think he's operating in the world of Micah Parsons. I don't know if you know this part, but there's a linebacker for the Dallas Cowboys named Micah Parsons. And he complained about the price of something on Twitter this year. And I don't remember what it was, but everybody was like, yo, bro, you just signed a contract for $12 million. You can't be complaining about the price of anything. Like, you're not in the discussion to complain. And for him, he made $60 million off of his transactions of selling stock and salary last year. There is no way in hell he should be talking to anyone to be relative to retail when they're losing their life savings, a couple of $1,000. And I'll tell you, this popcorn deal doesn't make sense to me either.
Yeah, like me and one of your moderators really poked at this. Like, I don't, from a CEO perspective, I just kind of hate the narrative he's putting out, just because he's not, I don't feel like super honest with his shareholders. Like, I don't have a position in this. I don't really care. This is just numbers to me. Like, That's what kind of my job. But like, I don't like the narrative, and it's all smoke and mirrors. Like, your moderator and I, we did the numbers last night, and it's like, of the entire microwave market, it is a $5 billion market, but you crack it open and only a fourth of that goes to the States, right? So it's about a 1.3 billion. And then you look at the players in that, and you know what? It's a tough market, right? You're talking about putting stuff on Walmart shelves, right? And the margins aren't these mystical, like, 500%. They'll be lucky to get net, like what, 20-25% per bag,
not
right?
Even.
And then you have not even, right? Because like the grocery store stuff is crazy competitive,
you're looking
right?
At 14 to 50 in that range, 14%, somewhere in that range.
Yeah.
And I'm just telling you because I'm in the business, so there's no way you're going to net a profit. Not a profit that you can manage. It has to be organic. It has to be from the ground up. And this is what I said earlier, and people weren't listening. Like if they were listening, but they're like half-hearted listening. Is like when you have a product, your company is driven by that one singular product. When that product's not strong enough to carry your company, you should really look at your business model. And so the product in this place is movies. Movies are the business model, and it's the product. So when it's not strong enough to carry your industry, your company, you're gonna have to shift, sure. And I call that diversification because I read that somewhere. But when you start making like 8 different things your new business, and you're getting away from the core of the business, and it's not going to carry you. This is the unraveling of a company. It's absolutely matter of fact. And you always hear this thing, it's when you start listening to the crowd, you will soon join the crowd. And that's exactly what's happening with him, where he's taking his recommendations from his shareholders, the crowd. And I'm not saying that they can't give you great advice or great insight, but you can't run this business this way. You're on.
Yeah, because where I struggle is people have a lot of money tied up in this thing, and I feel like people talk in these hypotheticals, but if you really start thinking about this, like just from a pure number standpoint, like they lost 280 million this quarter. Okay, so if you back into the math on what it would take to break even on the core business, you're talking 30 to 40% more revenue to get there. Okay, that's a lot. It's a big jump. And then now we're going to shift into this popcorn thing. A lot of my career has been manufacturing, but manufacturing is really difficult, right? They could co-pack this stuff and it cuts some complexity out. But at the end of the day, like this stuff, it's going to cost cash up front. You're going to have a CapEx spend of quite a bit, I would guess, if they're going to do it the scale they're talking about. And then the margins aren't there. And then, oh, by the way, you got to bring in folks who know how to run these things, right? Because retail and manufacturing are 2 very different businesses. And you've only got you got like 6 months of liquidity to start with, right? So
but you're talking about the core of your business. You don't have 6 months of liquidity to push out popcorn. You don't have that.
No, I was being nice.
No, there's no way. I mean, who are you paying to deliver? Like you're palletizing, you're designing, you're going to sell bags of popcorn. I'm going to tell you the price that he said. The price he came up with was, and I'm just going to give it to you guys really quick because I have it here. 1 second. Let me see if I lied. I have it and then I don't. There we go. It's my history. I got to look at the history of this. The price he came up with, if I'm not mistaken, was it was $3.98. He said for a pack of 6.
Yeah, that sounds right. Yep, that sounds right.
It came out to like 83 cents. I want to say 83 cents. Yeah, $4.98. $4.98 for a pack of 6 bags. So you're like $5 for 6 bags. You're going to pay 83 cents a bag. I'm going to give you the example. If you had the same packaging as Kirkland sells a 44 pack for $13.99. And when you're selling, you're going to be Kirkland. You're basically getting for $13. You're getting 44. You're selling them at 29 cents. You're 4 times more expensive than the standard of the community of the product itself here stateside. You're 4 times more. There's no way. The business model makes sense in a flash, but people are not paying $5 for 6 packs of popcorn. They're not going to do it when they're going to have everybody else is available on that shelf. You'll see. They're going to be like, ooh, that's the overpriced stuff. I won't buy that. It'll be a select few. And let's just say it's 4 million people. I just even give you this. There's 4 million investors supposedly. And the 4 million people buy the bags, right? They each buy a pack. I'm just giving you the example. They each buy a pack. They're $5 a piece. You just sold $20 million. $20 million on that. Watch this. You don't even have 4 million. You don't even have 4 million boxes to sell. You don't have the distribution. You don't know where to send it, what market you're selling it in, what are the logistics for this? Who are you paying to transfer the product? I mean, because it's not you. AMC has no distribution center. They have no production center. They're paying third party on everything. So how they're going to make a profit on this said product is beyond me. But I'll watch and I'll laugh because it's never going to hit the bottom line. But more than that, I'll tell you one more last part about this. Even if they had $20 million, 10% of 20 million is 2 million. Okay?
I think a lot of people miss that. Yeah. It's not the revenue number. If you're trying to wipe the earnings, you're talking about the margin from this stuff, right? And like Linder, one of your moderators and I, Linderall, I think how to say that. We did the math last night, and it worked out to be 31 bags of popcorn per 8 member per quarter.
to wipe out the debt. I agree with that. I agree with that.
No, just to get to even. No, not even wipe the debt, just to get to even.
Yeah, you're not paying off debt. Yeah, you're just net zero.
I just want to get to zero, baby.
You're not gonna get there. You guys got to buy 30 boxes of popcorn each, and you better hope that somebody else doesn't. I don't know if one guy doesn't. There you go. Now you got to buy 32. Like it's gonna be that bad. It's gonna be.
Open up diabetes clinics right next to AMC. That should be a good business model.
Well, you know what I love? I love that we have a group of guys here that understand what I call spaghetti advertising or spaghetti. What do I call it, guys? I don't even know. Just spaghetti sales or whatever. It's one of those things where, and I don't know if you know this term, because this is what they do. This is what I think Adam Aaron's doing, is they put like a whole bunch of ideas on a plate, and then they throw it up against the wall and they see what sticks. And they use that term in law, in law enforcement. That's really where I learned it at first, but it's because lawyers used to put all these charges. They would trump all these charges on somebody, and you'd go into court and you'd see what would stick. Like, well, I didn't get him on this one, but I got him on this one. Like, I got him on, I didn't get him on battery. I didn't get him on assault. I didn't get him on rape, but I got him on indecent exposure. Like, it's like that. So like Adam Aaron's the same way. He's the same way.
Yeah, and it's the same thing. And like, like people can do what they want, but like I just really would have people like that invest long in these things, just like challenge the assumptions, right? 'Cause like these management presentations, they're not audited, they're not GAAP. And so when they throw out all these numbers, just go check the math. This stuff's not rocket science, right? But that's why I do it. Like I'm a redneck who just does numbers, right? And it's just, if they lost $1 billion and their gross margin on the average theater goer is 60%, right? Well, then how many people would it take to get there and start putting real stuff to it? Because I think these numbers are so huge that people just kind of get lost in it. Like, oh, we'll just go net positive. Well, no, it doesn't really work that way unless you do something huge to the business, right? So
what you're saying is be practical.
Be practical, do the math, check management. I'm not saying all management's out to lie on this stuff, but they're there to spin it. And when you go through the earnings thing, it just kind of reeks of that, just because we have a lot of P&L information, right? Which, we're trying to say they beat earnings, right? So of course they're going to give us expanded P&L statements. But then when I go to the balance sheet side, I got 5 lines. The balance sheet's what we care about.
Yeah, they didn't give you anything, but they'll give you a whole tangent about why you need to vote yes, because it's going to keep them afloat.
And then they're not even, I didn't hear anything that resembled a turnaround plan to me, right? Because like it's the liquidity is just a simple equation, right? You just take total available cash, which is $850 million. And then I go back to Q1, Q2 of this year. I look at operating income and, oh, great, I lost a couple $100 million.
Yeah. So what does that matter?
So then
there's an infinite liquidity crisis here. They can always get money because they're going to go back to the market. And what people don't, or people do know, it's the individuals that don't know, or the novice investors, where they think because markets always go up and to the right and it's free money out there, you can always borrow money, you can always stay afloat. Well, this is not one of those cycles. With the Fed increasing rates, it's harder to get this money. It's heavier on people. And the investors that were buying in before are not. So the ones that are pouncing are private equity. Private equity's leveraging this company out. And it's going to be that LBO. And when that happens, you're going to have that buyout. And I'm waiting. I'm just sitting here pretty looking at it saying, okay, there's Apollo. There's everyone else. Antura's here. And they're manipulating that outcome. And, it's one thing to do the stock, to do damage to the everyday algos where people, they're trading on the dark pools, they're doing the OTC. And I'm just like, I don't care about any of that. Go look at what they're doing to the company itself. Like, how can you combat what happens, on the stock market? Well, go look at the company. They're literally doing moves on purpose to ruin the company. And they're doing it, at the most opportune times. And you can tell me a year ago to the day, 2 weeks from now would be a year ago to the day that they bought into HYMC. That investment made 0 cents. It still makes 0 cents, but it was all about Mudrick. And it's all about that the connecting the dots that I have here. I know we have in the chat a guy like Scavengers here, this failed YouTuber guy. He's here and he says, you're all over AMC, you need the views. Well, Scavenger, first you say I get no views, and now I'm getting views. I don't understand. It's kind of like Adam Aaron saying he has a strong balance sheet, but then he's saying, I need you guys to let me dilute this shit because we need to get stronger because we're not strong enough. And it's, how do you blame something? And I know you were looking at the balance sheet there, running from Bears. How the hell is AMC saying that the pandemic put them here when they were already there before the pandemic?
Yeah, it's a good comment. And we can talk about this. So like they were already in this situation, I feel like in 2019, right? Because like when I pulled up the 2019 balance sheet, right, they leveraged up. I see a pop of about 4.8 billion on operating leased assets to 4.9 billion of liabilities, right? And the thing about it is when you look at like the full pre-pandemic year, like cash flow was barely even, but then they had a loss, right? And then I was digging through the Q3 footnotes, and there's a footnote in there, management's words, AMC's management is talking about AMC, where they say, unless we get back to pre-pandemic traffic, we will have to seek additional liquidity options that involve dilutions and could possibly involve bankruptcy proceedings, right? And then it's like, okay, then I went back and pulled the number of theaters that we have, or they have, and they're down 7% from pre-pandemic. So not only do you need to go back to when you're pulling 5 to 5.5 billion, you have to do so on 7% less theaters, which is, in my mind, fairly material. And then then it gets better because you go to the earnings report, and then Adam Aaron in here is saying, as we've been saying for a long time, the industry box office won't return to pre-pandemic until 2024 or 2025. And it's like your own management saying, if you don't get to pre-pandemic in the next year, you're probably toast, right? So it's just people can do what they want, but if you start poking at this stuff, the logic starts falling apart on me.
Well,
people can do what they want.
I have the 10K. I have it here. Just give me a second. The new one that just got released. It just got released right now. We'll read it. I'm going to read it over, but I just got to make sure I find my mouse. Dude, I wish I had multiple monitors because my mouse hides on one of the screens every time it does this crap. And then I got to find it. And then I look like I'm all over the place with you guys. Let's see where I find it, though. Anyway, how you been, though, brother? I know you didn't work today or what? Or you got off early?
I mean, I consult, right? So when I'm busy, I'm really busy. When I'm not.
That's cool.
This is one of these slower days. So like this worked out nice. Plus, I've been looking forward to this for a while just because I really don't like the narrative around this stock for, retail investors. Like the stuff that management says, I just don't. So I like that you're trying to.
Well, I've been listening to earnings calls for a long time. Like I have one coming up on Thursday that I have to listen to. And, I've never heard management talk the way this guy talks, and it's not. That's not a positive. What I'm saying is, I've never heard somebody try to manipulate the way the company's going to their shareholders. I've heard management say, "Hey guys, we didn't do too well this quarter. We need to raise some more liquidity. We need to do a share offering. We need to get out of this hole." Like they're so realistic with it, and this guy's totally the opposite. And so I'm going to go over this line for line, but we'll keep talking. And then, of course, I got to read the chat at some point. I know the chat's going. And love you all. Thanks for being Jamie Elitas. Got to go play some Harry Potter. Kingsbury, no problem. Go over this 10K myself. We've been live for 6 hours, guys. I'm not going anywhere. And let's see what we have here. We have an estimate that our exiting cash and cash equivalents will be sufficient to comply with the minimum liquidity requirements of financial covenant requirements. But we know that those financial covenant the requirements for them were waived for this whole year. So if you read it here, it says the current maturity date, whatever it may be, April of 22nd, 2024. But I believe they were waived until that time frame, if I'm not mistaken. So no covenants will come sit on them this year.
Yeah, for me, it's part of the, we don't have a lot of liquidity to begin with. Revenues are way down, right? We're sub 4, and then you get this deferred rent problem, right? Where they look like they kicked the can on rent, that they're having to pay cash out now. And then when you look at, like I pulled up, the Q3 or the 10Q for the Q3, and then you go to item 2, and it's, just straight up, there's risk around credit, right? Credit liquidity.
Yeah. Well, he said they closed down some movie theaters, right? And then he opened up new ones. So they're at 940. And I know everyone says, well, they should really they can't shut them all down. They don't know how to shut them all down because the lease terms on these movie theaters are, they're non-cancelable loans. So that means that you have to have them for X amount of years, all the way up to 15 years. And if people only knew, if there's a dead movie theater out there, there's no getting rid of it. They can't cancel it. I'm looking.
Yeah, I just think it's complex too, right? When you start talking about closing down, underperforming stuff and this and that, like in real world stuff, that's not easy to do. Like you said, if it's even possible, it's not easy, which is code for if you are able to do it, then you're probably going to get slapped with quite a bit of one-timers to get out of it, right?
Yeah, without a doubt. Extras. Extra. Well, nowhere in here did he say he plans on paying off debt. I just want to put that out there. He didn't say that once. He says they need to get more liquidity. They need to stay, afloat, whatever it may be. But he never said he's going to pay off debt. You can't pay off the debt early because there's a charge there, a make-whole premium charge for every loan that they're on. All these bonds that they have to pay off. But I'm reading this as fast as I can. I'm going through it, looking for.
And then, well, I looked at, I was poking through the Q3 statement, and I can see where they rolled out their 25 and 26 notes and 29, and then they paid about $75 million in premiums to do so, right? And it's like, would a healthy balance sheet company do that? Maybe not, right? But that feels weird when we don't have much cash to begin with.
Yeah, you're just giving up 80 million, 70 million here and there. And no, it's not a big deal because people are numb to the number. People are numb to the number of $500 million. Like, it's not a big deal. $1 billion, that's not a big deal.
10% of available liquidity right now, right? So it was a very real decision to do that from management's perspective, right? And then where's the other note? They straight up say it.
I'm also a big believer that the credit card will make them $0. And he kind of pointed that out. He says, listen, it's not a huge risk for us. And the reason why is because there's nothing to be made from it. It's like a tack on. You don't make money from the credit card itself. People have to know that. The relationship that you risk is that the deserved bank that's doing it, they will in turn represent you for any customer relations issues with the credit card. Like you're putting a lot of risk on someone when you do a co-branded credit card. It's just not a business thing that you do unless you're really confident in the company you're dealing with. And I don't think they are. I think they're rushing for everything.
Yeah, and it's just, like you said, the core business is struggling. So you either have to shed theaters, you have to get attendance up, or you've got to get rid of the debt so it's not such a burden to service this thing, right? And if you can't do one of those core things, then if the engine's about to blow up, I just can't put new tires on it, right? Like, you got to fix the engine.
Right. But here's the problem. You're trying to fix the engine while the car's running. Yeah. That's the problem. You got to be able to shut it off. So the industry's best year ever in terms of revenues was 20.
Yeah, so in the Q3, like straight from the item number 2, if such additional liquidity were not realized or insufficient, we would likely seek an in-court or out-of-court restructuring of our liabilities, which that's Chapter 11. And in the event of such future liquidation or bankruptcy proceeding, holders of our common stock, AMC preferred units, and other securities likely would suffer a total loss. It's in the Q3 statements.
Well, the revenue, here we go. It says here, and they put this in here for the box office, how much money they've made. They made $7.4 billion was the box. You would basically have to have 80% of the box office to even break even. Is what that means. I don't think people understand how that's not possible. It's just not possible. There's so many independent movie theaters. There's other chains. Cinemark does exist, and these guys are never going to get there. Okay. Yeah,
stuff's so competitive, right? Like, you just can't say you're gonna. Not you, but like AMC. Like, it's not. Even with competitors going bankrupt, like these new lines of businesses and existing theaters, they're just not going to hand you money, right? So it's got to be a strategic thing where you're going to have some sort of new focus to get through this, right? What really bugs me is just continuing to paying on shareholders. If you don't give us this dilution, we're done. Like, well, you're already done anyway, Jag, right? So.
It's just as crazy. I'm reading about Adam Aaron. I told you he was on the board of directors for Centricus Acquisitions. If you know that they were bought out and that it was a broker deal through Apollo. He's also an operating partner of Apollo. He was senior operating partner, Norwegian Cruise Lines. That's Apollo as well. We know his ties to Apollo, and I'm looking to see if I can find any other ties to Apollo from these other guys, because I didn't know him before like I do now. You know, like this guy's on the board of directors at Highcroft now. You know, Sean Goodman, because of the position they did with Mudrick, which is terrible, if you ask me.
Yeah, it's such a grift.
Oh, it was bad, man. And I don't know why people don't pounce on that and talk about it, but I'm just reading up on the board of directors really quick, real fast, just see if anything like reminds me of what's going down. This is Delotti Consulting. I've been watching them everywhere. I wonder who the hell they are. I have to go find out. But I'm gonna get to the list of like what it actually is. I'm guys, I'm sorry if you guys are here in the chat and I'm not reading your chat, but I'm gonna be going through all of this because here's the thing that's tricky to me is the price of the movies to like distribute them, right? Like there's a theatrical release price that went up, and so you're paying more for your product. You in turn should be making more money, or you have to compensate for that price increase, and that's a big deal to me. And the fact that they have nothing to compensate for it shows it hits the bottom line straight up. So I'm on my way there.
Yeah. Because it's, like talking, like just think about like this cash flow statement, right? And they burned, because like a healthy company, like free cash flow is what you want, right? So there's three sections. You got operations, investing, and financing. And operations is kind of what it sounds like, right? It's a day-to-day business. Can they generate cash by like positive income, by not loading up inventory, by paying their bills, by collecting on invoices, all that kind of good stuff. And then you want to also look at investing, which is like basically your CapEx, right? And then financing would be either borrow money or you're going to raise money through dilutions or buybacks, right? So, companies that generate free cash flow, which is going to be operations minus investing. So say like your business generates $1 billion in cash and they spend $300 million in CapEx and they generated $700 million in cash. That's what you want. Right. But in AMC's case, the day-to-day business burns cash and they turn around and dump it into CapEx, right? So it's a double whammy of where you're actually burning real cash, and then you turn around doing these kind of like harebrained, I shouldn't say harebrained, you're gonna do these kind of like odd investments, and then so your only way out, if I can't make money operating and I'm burning money on CapEx, then literally the only place cash has to come from is shareholders, right? You have to dilute it. So if I was long on this thing, I'd really want to understand what the path is to get back to just to even, right? And then when you do that, run the numbers on like, if we're talking theater goers, how many is it? How many bags of popcorn? Right? If I had to start launching popcorn in outer space, so be it.
You gotta sell millions and millions and millions.
I know it's not even feasible, but just do the math, right? People like haven't already.
Bed Bath and Beyond to sell 5 billion pillows. It's not gonna happen. Anyway, so if you're looking at the sheet here that I have up, it shows you how many movie theaters are leased. 824 are leased. That's what I'm trying to tell you. It's impossible to get out from under those. They only own 41 movie theaters, so they really don't have any assets.
No, and it's even worse on the operating lease side. Like I appreciate you bringing that up, because like the operating lease is $4.2 billion, and the assets are only booked for $3.8 billion, right? So just to get out of that, just using kind of redneck terms, they're $400 million upside down their operating leases, right? So even the stuff they don't own, they're upside down on.
Deferred rent is real. And they're not paying that bill. I just don't understand it, how people are oblivious to this, or they go watch these YouTubers that are, there's YouTubers right now streaming saying, this is good news, guys. This is good news.
I just, at the end of the day, because I think what bugs me too is like when people talk about the debt, they don't talk about it in its entirety, right? So there's $5.2 billion of debt. That's just a long-term part. Like all liabilities together is $11.8 billion. That's only against $9.2 billion in assets, right? So they're upside down by $2.6 billion. And those are just numbers, right?
That's a real number, though.
Those are real numbers.
You can't get that back.
Yeah. If I'm upside down on my house, right, I've got to bring cash to the table to get out from the thing, right? So that's what we're saying here from just an accounting perspective.
This is what we're saying here. And I'm just so people understand, if you're buying a house for $500,000 and you're going to go make some monthly payments, but then when you go back to the bank and they tell you, well, now that house costs $750 million, Doesn't matter how many payments you make, the value of the house keeps going up. And it's not the value, the expense of the house, the loan itself keeps going up. That's what people are not getting. It's an infinite balloon, and it's not going down. All right, here we go. I'm on the numbers now for the year to date. This is last 5 years. Admissions, top line revenue, they're not even close. They are 30% down from 2018 and 19, and 30% is massive. That is a massive number. And I'm looking at total revenue. You can't even get, they're missing $2.5 billion, $1.5 billion. Like, you got to respect that number.
Yeah, that's just to get to even, man.
Yeah.
And they're more leveraged than they've ever been. Like, what's the game here? So,
and to give you a better example, the admissions represents about 50% of what film exhibition costs are. So your admissions cover 50% of film exhibition. They did better in 2020 on average, better in 2021. In no other year did they do a little bit better than that. So yeah, it's not that great. They're half of it. So I'm just looking at what they cost to put on a movie. Cost too much. And then the food and beverage costs, everything's gone up. You know that. They're nowhere near it. They're nowhere near it. Food and beverage costs. Wow, 230. I'll just say $230 million compared to 270 that they paid in 2018. So they're paying 40 million less, but they're making $1.5 billion more back then. So that is a crazy number when I really think about it. Holy shit.
Yeah. And it's just, because we're like about the financial statements, and I'm a CPA, of course, when I say this, like I like to, like if retail investors are going long on something, like to look at all three statements, because the way accounting is, right, everything's a debit and a credit, so stuff affects multiple statements at the same time, right? So if one thing looks out of whack, there's probably something on the other side of the entry that's making it look even worse, right? So I do think it's important as retail to know, I always start with the P&L last, because it's actually kind of easy to generate a good looking income statement, right? Not in this case, but normally I can dress up a P&L, but then you'll find the issues on the cash flow statement, the balance sheet, right? Because it can't get cash in the door, and then liabilities are piling up. So it doesn't matter how good the income statement looks, you're going to get tanked, right? Because cash is what kills these things. But in AMC's case, unfortunately, like, income statement alone is just objectively rough, right? It's just bleeding off huge amounts of millions of dollars a quarter,
what people want to look
hundreds
at
of million.
Is the operating income loss. Like just straight cash to what it costs. Like, what does it cost to do business, and what do I bring in the door? And get away from the controllable expenses, or I would say the non-controllable expenses, right? So if you're going to talk about just apples to, like, what it costs, like food, beverage, movies, what's that cost for you to get in, and then the rent, whatever it may be, right? But you're not building in, and I don't really see any SG&A in here. I don't see the salaries in here or anything to that effect, like what payroll costs. I have to look at this more closely. But what I am looking at,
they kind of it is a little, the way this statement is structured, it's not broken out like I would expect to answer your question. That's a fair statement, because it's just kind of lumped in, which is, they can report these things out different, right? But it is kind of hard to tell, like, what's what, right? Like, because I want to know, because we know what gross profit is. That's easy to give that. But then on the operating section, like, what's payroll, what's non-payroll, right? And that kind of thing, So,
I would break it down that far. I would even break it down to, like, what maintenance and or I would do, like, supplies. I would have so many things. But I'm looking at this, and I see that the impairment, they lost $2.5 billion in 2020. Like, I don't even think people realize that. That's a crazy number.
It's a crazy number, right? And the problem is, when you do impairment stuff of assets, you're going to look at the fair value, which is generally some sort of like free cash flow measurement, right? Just broadly speaking. And so when everything went to zero, you just got to write that crap down. So like that's a real hit to the P&L. And because I think sometimes in finance, people like to just, one-timers, right? They'll just, because everyone's so big on EBITDA. Like I really can't express my disdain for EBITDA and ignoring one-timers. Because to me, if you've got one-timers piling up, that's symptomatic of the business is struggling to manage its balance sheet, right? Because, to impair stuff from to impair stuff from an accounting perspective, like that's a whole process, right? It's not like you just go, oh, we're going to write it down 100 million, right? There's a lot of math behind that, right? It's very subjective. So, one-timers are real things.
Well, operating income, like they really made like $265 million in 2018, $136 million. Like they had that, but the thing that held them back was the debt itself. They had these interest payments that they were making. And that's what was drawing them back, even in those big years. But they seemed okay because at 265, that's free cash flow. Like you're operating on something.
Yeah.
And now you're doing $1 billion losses. I mean, you're doing $500 million losses on a year when you had Top Gun, when you had Avatar, you had Wakanda, you had Jurassic Park, you had Minions. I mean, they had a whole slate of movies and they still lost $500 million cash flow wise. And I'm not even saying that's the total loss because there's so much more involved in there, the corporate borrowings and that come into play. But I don't care how you restructure it. $1 billion? God, man.
Yeah, it just shows how leveraged this thing is, right? Because it took them, it's going to, like, even using the numbers for this year, they'd have had to be at 5.5 just to get to even. Like, leverage works both ways, right? Like, you can make big money with it, but if you don't get the attendance, then it's just you're dead out of the gate, right? So that's a good point.
Yeah, they're down 150 million people. That's how much they're down on people coming. So no one's going to movie theaters. I said that. I mean, I said it's a dead industry, but I don't know how more titles get people there more often when they're like, I'll give you the example. You're not going to get more than that. We just disconnected. Now we're reconnecting. I hope.
You there?
Yeah, we're good. But the stream itself, remember, it's been streaming for 7 hours straight, brother.
Yeah, no, it's fair. Because like their whole thing is if they return to pre-pandemic audiences, like I don't know that it's ever going to be the case, right? I feel like viewing habits changed, right? Because I might go see like one movie a year.
We're at home, brother. We're at home.
Yeah, I don't care as much like I used to.
Well, somebody said something. Let me read this chat really quick. This guy's excited. I agree with Morantz on the debt payoff. All loans support the bankruptcy goal. Well, that's the plan. The plan is to file for bankruptcy and then inverse, have private equity sweep in and buy it out of bankruptcy court. I wouldn't be surprised if the lawyers for that are going to be Sullivan and Cromwell and or White and Case and the same group of characters. Hell, even Kirkland. So I just don't know what they're planning and how they're going to do it. But I've seen two gods sell them back and forth to each other. That's Ares and Apollo. They've sold to each other. And they're both related, which is really crazy. I don't know if you knew that. Did you know that?
I didn't know that. That's interesting.
So Apollo, the founders of Apollo broke off and made a company called Ares. And the two founding guys, Leon Black and the other guy's name is Tony Resler, they're actually brother-in-law to each other. He married, Leon Black married Tony Resler's sister. So when they do deals to each other, it's just like one family selling to the next. But they run the biggest private equity hedge funds in the world, basically. And yeah, they killed Smart and Final company, grocery store. They destroyed it. So that's what you have.
I hate seeing that stuff.
Yeah, it's stuff I'm digging out.
Yeah, no, it's interesting. This stuff's all kind of wild. It's like this one comment on here about we're missing the real picture when the debt is reduced. AMC will start making cash flow positive. I guess my challenge to that would be like, okay, let's put real numbers to that. Like, don't just throw that out there. Like, okay, if I show $1 billion loss and gross margin is 66%, that means I have to have 1.5 billion more in revenue to get to even. So how, like, my challenge back would be like, how? Right? Do you think if there was a way to get $1.5 billion more into theaters, they would have done it? Probably.
Yeah, but not only do you need $1.5 billion more to break even, how are you going to pay off the debt? We're not even talking about a dollar to debt. We're just talking about let's be operational first. Then now let's pay off $1 in debt, which you can't do. It's impossible. I'm sorry, the business model doesn't work. So like banks right now, it would behoove every bank and every hedge fund to short this stock because they know that in a year from now, one of the banks is going to call the covenants to the table. One will. So someone's going to win. and it's not going to be retail. There's just no way. I'm sorry, guys. There's nothing here for me, and that's what.
And
go ahead.
It's a great point. No, it's a great. Sorry, it's a great point because like even if we because everything I've said today, I've just tried to literally get back to even. But if we want to start throwing stuff around, like not you, but like
I know.
If they want to get cash flow positive because of the debt, like well, interest coverage ratio, that's a thing, right? So how much EBIT did you make over your interest payment? Okay, so if I go back to Q3, they had. Call 85 million of interest, right? And a low interest coverage ratio is going to be 1.5. So in order to be considered on the low end of safe, I would have to generate 130 million of EBIT to cover my interest, right? And then but then for Q3, I was at a loss of 114 million. So that's a $250 million swing on earnings. So like if we're saying I'm missing the picture, someone please walk me on it because I'm missing it hard.
Yeah, no, it's not that. Here's the thing, and people always forget about that. On EBITDA, the biggest thing is the I, the letter I.
Yeah,
it's the interest itself. So if they only knew what Adam Aaron knows. Because Adam Aaron knows all this, guys. Okay.
Yeah.
They're not stupid.
He knows what he's doing.
Yeah. He knows exactly what he's doing. So if he can not have to show you how bad it is and mask it with ideas and thoughts and hopes and dreams, he's going to do that. He's going to give you NFTs. He's going to give you free popcorn. He's going to give you a shiny bag at Walmart and not even tell you how much it costs to put it there. To land that item on the shelf, it's going to cost you even more. You guys want to talk about debt? I'm going to tell you about debt real quick. The more you put into something, I know this is common, but the more you put into something, the faster you sink. And they're putting out ideas and things they already shed out. I'll give you this example. 25, what did they put? Give me the number. Is it 25 or 50 million into HYMC? I want to say from 25 to 50, whatever they did.
It was like 25 million now, 25, 30 million. 25
million. Okay. That's 10% of what they lost this quarter. They did that in quarter 1 of last year. Like when you're dealing with whole numbers, I'm giving up 10% to HYMC. I'm giving up another 10% to Nicole Kidman. And now you're talking about 20% in expenses that you'll never get back. You'll never get back. You're not getting that money back. So I, as an operator, I need to find a way to reel in his spending and to say, hey, at some point we got to stop this shit. Like, when is enough? And it's not going to be, because they're going to pay for a third-party credit card. They're going to pay to accept, what is this? They're accepting the cryptocurrency. They have to pay for all of this. I don't think people understand credit card fees either. With having a credit card, taking those, you have to pay MasterCard and Visa and American Express whenever somebody uses the card at your establishment. And the only way to offset those charges are going to be, it's not that you got to sell more, because that's not going to happen either. You would have got the money, whether it be cash, debit, or new credit card, but you got to go get approvals. All these guys are going to go run to this place to get a third-party credit card with terrible debt. Like, they're already making bad decisions. What the hell? Go make them another one.
And it's just it speaks to how because I think it's sometimes easy to lose sight of like these are huge businesses, right? And like good businesses run on incremental margins, right? Because it's so hard to make it marginally better, and because it's so competitive out there. So in these ideas, it's just going to barely move the needle on stuff, right? Unless you can fix the core business, which is at the end of the day, you got to find a way to drive either 30% more revenue, or you have to go through this SG&A bucket and start whacking stuff, right? And most of it's rent. There's like, what are you going to cut, right?
So, there's not enough. You got to take a pay cut. I'm talking about a pay cut across the board. I don't know. That's not even enough. Yeah. But look at this. Operating costs and expenses increased $1 billion, guys. $975 million. That is outrageous. That is outrageous. Food increased $90 million. These are expenses, guys. This is crazy.
You think about actually spending that amount of money. It's honestly kind of wild, right? Like you spent $1 billion.
Shit, man.
And you still lost.
Yeah, but you don't have nothing to show for the billion. Like, oh man, I hope people know how to read this stuff. I really hope they do, because it's not gonna. Yeah. It's going to be really bad. It's gotten worse. Whenever somebody says it can't get much worse, well, keep sitting there. Investment expense of 14.9 million for the year that ended, blah, blah, blah. HYMC offset by 6.2 of appreciation estimated fair value of our investment in warrants purchase. Yeah, negative 6.2. So they're losing money on these investments. They had a decline on the other portion of it, almost 6 million. So they've lost $13 million on that investment. That's not good for them, man. That's not good at all.
Wall Street bets action right there.
Yeah. What happened?
Some Wall Street bets action right there. Down.
Oh, yeah. I mean, they want to put the loss porn. He should start posting loss porn and see how many upclicks he gets. Maybe he's going to get more viewers on his Twitter that he keeps talking about. I've never heard a CEO brag about how many viewers they have, how many interactions they have. I mean, this guy's, I don't know. How do you feel? How do you feel about him using corporate funds to travel the world, to go to these movie theaters, and it just so happens he goes to the sporting event at the same place?
I got a real problem with corporate spend, right?
Yeah.
It's coming on the backs of shareholders. That stuff bugs me so much, because executives, they'll get paid regardless of what happens in the business, because the businesses are like pretty resilient, right? Like no matter what kind of leadership you have, it's still going to function decently well. But when these things go bust, it's the people working the floors that get left holding the bag, right? And their families. That's really the shame of all this. Because this all was avoidable.
Man, you know what I think? I don't think he's trying to get hit by shit. Like, that's my biggest thing. Hey, you know what? Hey, I'm going to tell you something else, dude. So I don't see somebody typing in the chat right now, but I see him. My boy Pepper with Salt is here. Peppered's here, bro. Hey, Peppered, I love you, man. I saw you just muted one of the guys talking some shit in the chat. That's how I know you're here. But you didn't type anything. But we love you, brother. Just want to point that out. I'll explain debt. I sold my AMC this morning and a tad bit of profit and just paid off my own debt. Now I'm free and clear. Thanks, Adam Aaron. Couldn't have paid it as he paid, man. Good job, Scott. You did great. Can't wait for Bigums to spin this. No, you got. I can wait. The credit card fees can be pushed to the customer now, unless I'm mistaken. I shall be. No, it's still still a
cost.
Yeah, it's still against you. It's not that you can charge them all you want. You're going to charge more now for them to use the credit card? Go for it. Let me know how that works out for you. You're going to just keep spending more, but it doesn't matter. You still have to pay. It comes off of you, I promise. Because you remember that you don't pay taxes on those. But you're going to pay. What do you pay? Do you even pay taxes at movie theaters for anything? The food itself, nothing? It's all built in? I don't know what's going on.
They bake it in, don't they? I think they bake it in.
Yeah, this whole damn thing is baked. Bro, hey, I'm ready. I'm ready. You know what? I don't drink anymore as of last week. And I don't drink soda anymore. I'm trying to lose some weight. I hit 248 pounds. And I was like, yeah, that's my limit. But because I don't want to look like Adam Aaron when I get older, all wrinkled and only fitting like 5 things. But I'm still getting down to the bottom, bro. This shit. This is the annual report. I'm on page 69, but we're getting there. And I said 69. Let's see, nothing. He charges everything off. Like cash flow's gone. Net lost 295 million. God, just huge numbers, man. Oh, God.
These are real things.
Yeah. And, you might read a balance sheet of somebody, and they might not know how bad this is because this might be the only one they read. But when you go look at GameStop, which, hey, guys, hi. I'll give you this example, okay? GameStop sold over $1 billion worth of stuff last quarter 3. They had all this stuff on the chart, right? And when it's all said and done, the previous year they lost 110 million. This year they lost 90 million, going in the right direction to zero. But $90 million, guys, that's the whole number, okay? For the whole quarter, $30 million. These guys are losing 3 times that much. And for what? I don't understand the business model. I don't know where it's headed. And I know you guys are going to be like, well, by the way, GameStop, $177 million free cash flow positive. I only compare the two because they're connected for whatever reason. Somebody decided they'd be connected together, but not in my mind.
No, like it's like from a pure accounting standpoint, GameStop, you can tell there's direction based on the balance sheet and cash flow statement alone. Like it's trended positive the last 2 years, right? There's clear direction to it.
Yeah, I'm looking for I'm looking for some good numbers there. I don't want to spoil it, man. I don't want to say it, but you know, when it comes to GameStop, I'm looking for them to be not only cash flow positive this quarter, but because you know they do 40% of their revenue in quarter four, and I'm thinking they can get you know, that break 0 point where they actually have earnings per share. So that's what I'm looking for.
It's gonna be close.
Yeah, it's going to be very close. But Wall Street has it at like negative 15 cents a share. And I'm thinking, I don't see how it's that. But, you know, I'm not Wall Street. I could be wrong. I've been wrong before. All right, here we go. Year ended. I'm looking at this number here. 333. Oh, yeah. If you just put these 3 years against each other, yeah. God, they look amazing. Look like they've been just going great these last 3 years. But I don't think people understand this number here. That it cost more, 1.5 billion to get that same 2.2. Like it actually costs that much. The rent itself, the rent has increased over the last 3 years. So even though you've shrunk your movie theaters and you got rid of a couple of hundred movie theaters, you're paying more. Rates go up on leases. And
they deferred them too, right, from the pandemic?
Yeah, exactly.
There's cash burn.
Yeah, it'll burn off that whole amount, man. The impairment charges themselves increase. I don't understand how that's not a bearish thing. It's bullish, bruh. Everything's bullish. Do you know who that is? Do you know who says, "Hey, it's bullish, man. That's bullish. I'm fucking bullish, bro." You know who that is? No, I don't know if you know him.
I don't want to guess.
Yeah, he's some guy, bro. He's some guy. Don't worry about it. His name is Kent. Soon, Josh. I'm just making. There we go. There we go, Pep. Awesome. I found this channel. I'll subscribe and hit the like button. Thanks. Scott, you're welcome, man. We've been around for a long time. Longer than any AMC YouTuber wants to admit. They're afraid. They're afraid. I think we're the longest running channel right now, so we're doing pretty good. We kill it. I'm just saying because AMC is still killing it out there. What are you talking about, the Vision? Hey, Vision, you went to work, you got off of work, and I'm still here. 7-hour live stream, and I'm still here. When are you going to put some respect on my name, damn it? Anyway, GME, great price point right now. NFA, opinion only. Nah, I'll give you great financial advice on that one. All right, let me look at this. Operating cost and expenses was $4.4 billion. Man, that means, guys, to break even for this company, they have to make $500 million more dollars somewhere. Somewhere out there. I don't know where. 500 million. That's just to break even this year. No way. That's a huge number, man.
A huge number.
But that's to break even just on operations costs. It's not about.
I gotta feed the dog.
Yeah, I hear you, brother.
But I appreciate you having me on, man. It's good.
No, you're good, man. Don't even sweat it. Everything, you guys have fun. I always appreciate you breaking down the numbers you can. And he's in the Discord, guys. He's a living legend. His name is Running with Bears. All right, he's running with those bears. Name Bed Bath & Beyond, but he's running from them too. But thank you so much, sir. Enjoy. And what's your dog's name since we saw the dog on the stream?
Oh, Molly. She's my 3-year-old golden sweetheart.
You're always carrying Molly. I always see you. You're not the biggest guy, but Molly's a big-ass dog, brother.
She's a big ass. She's a big girl now.
Yeah.
Love her to death.
Hey, well, much love to you and your family, man. Good luck, and reach out. We'll bring you back on for GameStop earnings.
All right, we'll talk soon, man.
Yes, sir. Thank you.
All right.